We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is John Titus, creator of the Best Evidence YouTube channel and Substack, and co-host of a weekly podcast with Catherine Austin Fitz over at Solari.com. John, thanks for joining me today.
It's good to see you again, Tom. It's been a while.
It has. I always say that, and it always blows my mind, how long it's been between times that I speak to all of my guests. And of course, the last time that you and I spoke, you laid out how you predicted the banking crisis that we saw in March of 2023, which feels like an eternity ago already. So I wanted to kind of start with reviewing that a little bit. Did that problem go away, or has it been kicked down the road as well with many of these other issues that we're going to talk about today?
There's two different issues bundled in the bank failure of Silicon Valley Bank and others in March of 2023. The prediction was, I based that on, which I did 3 weeks in advance. I did a video called "Why is the Federal Reserve Provoking a Financial Crisis?" Mm-hmm. Where I said you can look at the pattern of bank borrowing, commercial bank borrowing, and you can see they're panic borrowing right now. And every time they panic borrow from an entity called the Federal Home Loan Board, you get a banking crisis. So the banking crisis is here, the banking crisis is now, and then 3 weeks later, Silicon Valley Bank fails, and we're off and running. I did a second video called "Deep Diving the Fed's Killer Whale Crisis" that looked back at that bank crisis right after it happened to try to forensically piece together what was going on. And it was pretty obvious from Senate testimony. What had happened at Silicon Valley Bank and others is you have these massive bank deposits just walk out your door and the bank goes down. And that's what happened to Silicon Valley Bank. And Silicon Valley Bank, what was so kinky about that crisis is these are wealthy banks. It was precisely because the banks had massive deposits leave the door that caused the crisis. So, and that was a direct result of massive deposits. And by massive deposits, we're talking about on the order of $1 billion. And what's, the weird thing about a $1 billion deposit is, who on earth keeps $1 billion on deposit at a bank because it's uninsured, mm-hmm. right? You're insured up to $250,000. So if you have $1 billion, essentially 100% of that money is exposed to risk. But people were keeping those deposits in that volume on deposit at these banks. And when they left, the banks collapsed. That's what happened to Silicon Valley Bank. The point of the deep diving video was that what created those massive deposits was the Fed's quantitative easing program during the pandemic, specifically in the early part of the pandemic, say in the first 6 months, starting in March of 2020. The Fed went out and bought, ultimately purchased $4.5 trillion of assets, but it bought those assets from non-banks. And that caused the deposit base in the U.S. to swell, to expand by $4.5 trillion, which was a big deal because they started at $13.5 trillion in commercial deposits. So the Fed, its quantitative easing program during pandemic, caused commercial banking deposits in the United States to swell up by a third. That's where your inflation came from, mm-hmm. and that's where your crisis came from. And I lay that out in deep diving. It's one of the best videos I've made. There's no question that the Fed was behind that crisis. No doubt about that at all.
Mm-hmm. Well, I know at the time we were quite worried about, that problem manifesting again. So again, has that problem been kicked down the road, or has it really been solved? Or is it that, people realize that having $1 billion in a bank is a risk instead of, let's say, keeping it in short-term treasuries or something like that?
I think my best guess is that the problem has been kicked down the road, because I'm looking right now at a graph of deposits in commercial banks, and right now it's sitting at the St. Louis Fed, they changed the way they did their graphs, and they're terrible now. So it's much more cumbersome website to work with than it was before. But basically, bank deposits right now are sitting at $18 trillion. You know, I just told you that in March of 2020 they were $13.5 trillion. So the expansion hasn't gone away. The last time you and I talked was, say, March of, I can see it because I can see where the failure is. When you and I last talked, bank deposits were 17.3 trillion. So the problem hasn't gone away. It's been kicked down the road. You still have massive depositors out there. So the problem could rear its head anytime when you get these guys like Peter Thiel and these Silicon Valley guys. They get together and they decide to yank their deposits in volume like that out of a bank. The bank's going down. Right. And nothing like that ever happened in the global financial crisis because there weren't deposits of size. So you had like Washington Mutual went down, but we're talking about, you know, $6 billion in deposits leaving the bank over the course of weeks. And with Silicon Valley Bank, it was like, you know, 14 billion in deposits leaving in 6 hours. You know, that's the difference between, you know, nicking your thumb on the one hand and losing your right arm on the other hand. You know, one's going to cause you to die and one's not.
Right.
Washington Mutual had a lot of other problems up to and including fraud, but that's a different story. Anyway, this is the Fed's banking. That Silicon Valley Bank is the Fed's. It's the Fed's responsibility. They did that.
John, do you have any explanation for why these guys would hold so much cash in a bank, as you said, basically uninsured, versus, as I was kind of thinking about, let's say, holding it in a short-term treasury to make a little bit of interest on?
Yeah, that's this guy Joseph Wang. You know him?
Yeah, I've interviewed
He
him.
wrote a book called Central Banking 101. It's a good book, and you read it. And it's like, yeah, well, if you have a lot of money, $1 billion, you put it in treasuries because treasuries don't need insurance. It's the U.S. government. I mean, if the government fails, you've got other problems in your hands. Okay, you're not worried about money at that point. You've got other issues. So you put large volume money in short-term treasuries, and you know you stagger them. You buy short-term treasuries, and you buy one every 6 weeks, and you roll them over. You know, there's all sorts of games you can play to sort of keep your cash flow going and keep yourself so you can liquidate when you need to liquidate. And that's what you do. Why people keep $1 billion on account? I can think of no other reason than they want to take the bank down. I mean, in fact, in the video Deep Diving the Fed's Killer Whale Crisis, I cite two examples from history of people keeping large volume deposits, one of which is Bernie Madoff. Kept $5.6 billion at JP Morgan Chase. That's not a particularly shining example. The other example I found was from a book called Corporate Money versus U.S. Currency by by a guy named Alfred Owen Crozier. And Crozier cites an example of somebody keeping large deposits at a bank for the purpose of having leverage over that bank and being able to eventually take ownership of the bank. In other words, what I'm telling you is there's no good reason, there's no non-nefarious reason to keep massive amounts of money on deposit at the bank, precisely because you can lose that money. It's exposed to risk. So obviously you have some reason other than risk, since you're taking on risk, you have some other reason other than safety to do that. And I've never seen a decent explanation for what went on with Silicon Valley Bank and the others. It's just like, well, we don't want to talk about that. No one wants to talk about it. I want to talk about it. Why are these criminals holding huge amounts of money in the banks? You know, you think it's a good idea for an FBI informant like Peter Thiel to hold $1 billion at a bank? I don't. I think it ought to be looked into, but oh God, we can't do that.
Well, I think there's plenty of those situations throughout, let's say, the last 5 years that need to be looked into, but that will just be, forgotten about because it's inconvenient, let's say.
Yeah, right. So that's where we are. It really hasn't gone away from what I can tell from the graphs. Now, that said, Tom, I have not gone in and looked at bank by bank call reports like I did with those two videos recently. I haven't done that since I did Deep Diving the Fed's Killer Whale Crisis 2 years ago, basically, almost 2 years ago.
John, I'd like to move to a different topic that, is very much on a lot of people's minds over and above, this seemingly never-ending news cycle that we have right now. And that's talking about the Fed's federal debt right now. Do you think that the Fed has thought about and, let's say, laid out a plan to deal with the large fiscal deficits and regulatory capital constraints in order to be able to backstop the Treasury market liquidity if that becomes a problem?
Not really, not officially. Let me just put it that way, not officially. If you look at official Fed pronouncements, they've been saying, and the Treasury has been saying for at least 3 years, maybe more, that the United States is on a fiscally unsustainable path, and that what we need to do about it is we need to start reining in deficits so that they're a smaller percent of GDP. And what they mean by that is austerity. In other words, they're blaming us for the problem. Unofficially, you have policy papers that have been floated saying, big deficits and big debt like that presents a problem, just sort of a logistics problem with the Treasury market, because primary dealers are only so big, they can only handle so much volume, and eventually you're going to need, the Fed's going to need to buy treasuries directly, which right now I don't think is legal. I think there's some prohibition, some legal prohibition for the Fed to buy treasuries. I don't think it's not allowed to do that right now. And I've seen like policy papers and proposals saying, you're going to need to relax that, and don't worry about it. It's not a problem, because the interest payments on the debt at that point would, because the Fed is statutorily obligated to turn over the vast majority of its profits back to the Treasury, the huge interest payments would be recycled back into the U.S. government. That's the idea. Like, it's floated as that's a solution to the problem down the road. Mm-hmm. It never addresses, the problem of the system is you're creating, all of your money is created as debt with an interest rate attached to it. Mm-hmm. It doesn't address that. It just, it's like, well, we're just going to reroute the plumbing. Okay.
Well, originally, how was the Fed set up with, let's say, these intermediaries between it and the government, and what was the purpose of these intermediaries?
Well, if you look at testimony from the 40s, I think, actually Mariner Eccles, whose name adorns the Federal Reserve building in Washington, D.C., Mariner Eccles testified quite bluntly in the 40s that the purpose of the primary dealer system was just a sop to Wall Street, just to interpose Wall Street between the Federal Reserve and the Treasury. It's a bit like a mosquito with a blood funnel into the neck of the country, just sucking out money. This is the former Fed chairman saying, and a renowned former Fed chairman. Mariner Eccles is, he's Hall of Fame. He's in the pantheon of monetary history, saying, the purpose of the primary dealer system is to sop to Wall Street. It's the only real reason for it.
So is the current, let's say, situation with the debt that we're facing, is that the same idea of fiscal dominance that was initially presented by Charles Calamirez?
I don't know. I know that when you issuing, you got to finance your money like that, and you have a debt-based monetary system. Mm-hmm. Let's look at it this way. Financial assets, global financial assets, most of global financial assets, are treasuries. Something like 60% of financial assets are denominated in U.S. dollars. And a big reason for that is that debt is created as money. So this Federal Reserve system, that's its gas. That's what drives it. So more debt is more power. So let's issue more debt. Let's have more wars. Let's have more, boondoggle projects, because the more debt we create, the more interest we rake in. So I don't know I didn't read the Calamirez paper. I know who you're talking about. I always think of Calamari when I see the guy's name. But I don't know the paper.
Well, it's basically this idea that you're going to have to start issuing so much debt just to be able to service the interest payments, and that cycle just basically taking off and continuing into, basically a debt and inflationary spiral.
Yeah, I don't. It could that one could go either way, actually. Let's talk about the spiral first, and then we'll talk about the effects of it. The spiral you're talking about. Let's just look at it from our personal point of view. Let's say that your income is just, to use round numbers. Your income is $1,000 a month, mm-hmm. and you've got to make debt payments, and you've got to make interest payments on the debt you've got. You've taken out more and more and more credit card debt. And eventually you get to a point where the interest payment or the minimum payment on your credit card is more than your income. Okay, at that point it's over. When you're borrowing money to pay the interest, it's over. I don't know if you ever hung out at off-track betting places, but that's how guys. You see the guys walking around with their hands all gnarled and they got a limp and stuff. They were borrowing money to make the juice, mm-hmm. to pay the vig, and that's what happened. That's a bad, because you're physically unsustainable at that point. So, if the rest of the world sees the U.S. borrowing money to make the interest payment, man, that's not good. That's a problem. Mm-hmm. But what is that? So what do you do with that? If no one's, because no one at that point is going to buy your debt, I wouldn't think. So let's talk about the interest payment, though. There's really two different ways to look at interest payments. One is just what's the interest on the debt? You got to pay that. And the second way is, well, it might be a little bit bigger. The real interest payment is a little bigger than just the percent on the debt. The real interest payment is that component plus some other stuff that is really non-negotiable. Social Security payments, Medicare payments, Medicaid payments, those things, because those payments they're not legally contractual, but they're socially contractual, in that sort of the deal in the U.S. is when you're young and you're healthy and you're paying into the system, you pay into the system. We kind of tax you for that. But when you're older, the benefit is, the reason you're paying into the system is that when you're older and you're not making as much money and you're not as healthy, we'll give you some payment. We'll give you your payments back then. Mm-hmm. We'll give you a little bit of income to live on in the form of Social Security, Medicare, Medicaid to take care of you as your health begins to decline. Those are social contract payments that everybody expects them. I mean, there's not a politician in the world who's going to get up in front of a microphone and go, you know what, we're going to cut your Social Security payment in half. No one. You better wear a bulletproof vest if you're going to say something like that. And that was something that Luke Grumman pointed out, that there's more to the interest payment than just the mathematical calculation. So the interest payment, the real interest payment, the non-negotiable part of the debt and a deficit is bigger than it might first appear. But the way to handle that would be, you could handle it if you stop borrowing your money into existence, if you issued money to retire the debt. So the debt now is what? 35 trillion ballpark? I think,
35, 37, somewhere in there.
Okay. Well, you know what? You could pay that if the U.S. government, if Congress, because it's constitutionally charged with coining money, and it's charged with, issuing credit on the name of the United States, but it could coin money. Congress could issue legal tender and retire that debt. Now it would probably be very inflationary to do that, maybe, but the debt could be wiped away. It's not the intractable problem that as it's pitched. It's pitched as this problem. Oh my God, we're borrowing too much money, but they're never going to do that, because the debt-based monetary system benefits the people in power, the private, anonymous, trillionaires who are in power, they're never going to stand for that because they have total control over the country. They're not going to stand for that. And so we're in this spiral of more and more debt, more and more austerity. That's the bottom line.
Going back to, I think it was, let's say in 2021, I think it was, there was this idea floated about saying that they were going to possibly issue 2 platinum coins worth $1 trillion a piece. Is that the same kind of idea that they would have this ability to extinguish that debt?
The Treasury legally has that option, yes. Mm-hmm. Yes. Now, you'd have to think it through, right? Because your debt holders are a lot of different, they're different countries, different people, and it's going to have long-term effects. But the reason they're not going to do that is they're not going to ever abandon the debt-based monetary system. Mm-hmm. Not until there's public pressure to do that. And there's not public pressure to do that because the powers that be they have genius ways for convincing different people of different political stripes to go along with the debt-based monetary system, even without knowing that that's what they're really doing. So you have, on the left, they pitch MMT, modern monetary theory. That's pitched to lefties. Oh, debt, that's how you do it. Debt is money. Money is debt. No, it's not. And then for the people on the right, it's like, well, we want to pitch libertarianism and gold-backed money and all the rest. It's like, well, what you really mean is gold-backed debt. You wouldn't need any gold if it weren't any debt. But yeah, you gotta prop that debt up as it looks good because it's backed. It's powerful. It's backed by gold. But that you're buying into the debt-based monetary system when you do that. Mm-hmm. The Romans figured out eventually that really wasn't the metal that was given the coins their value. It was really the seal of the government that gives the coins their value. Mm-hmm. And I tell you who else figured it out in 1694 was the Bank of England. But ironically, they're the ones who introduced the debt-based monetary system at the wholesale central bank level back in the day. And we never looked back, mm-hmm. Sadly. In other words, when the Bank of England got started, I'm going to talk about this in the series I'm doing right now. When the Bank of England started in 1694, England had been out of the money issuing business for 30 years and was borrowing its money from, basically private bankers. The Bank of England comes along and says, hey, we noticed that they formed the Bank of England, and England needed to borrow £1 million. England could have issued that money. They could have gone to Parliament and said, pass the law, we'll issue £1 million. But they didn't do that. They had the Bank of England print up £1 million of notes, let's say 10,000 £100 notes. And England, the country, borrowed these notes with ink on them from the Bank of England Corporation at 10% interest. It's idiotic. They could have just printed the money. If you're going to print money, print money. If you're going to print money, if you want to print £1 million, print £1 million. But don't have someone else print £1 million and you borrow it from it. Or are you a total idiot? But that's what went on. Mm-hmm. It was the biggest scam ever. That's central bank. That's where the central banking scam. That's where and when it got started.
Going back to this idea of not necessarily needing gold unless you have debt, do you think that that's why, let's say, so many of these central banks around the world, especially the Eastern central banks, are stacking so much gold right now is because of the debt that they have accumulated?
Because of the debt they've accumulated? I kind of doubt it.
Okay.
The countries that seem to be stacking gold, and don't get me wrong. Listen, I'm personally a fan of precious metals, mm-hmm. particularly silver. I think it's you got to have that. You have to have silver, gold, personally, but just on a monetary sovereign level, you don't need it. But the countries that are stacking the gold they tend to be producer countries with who run surpluses. And I think that, they're doing that because the world is so conditioned to thinking, hey, that's a solid currency. And, there's something to that. I mean, how much gold do you really think is at the New York Fed or in Fort Knox or wherever? Probably not that much, if I had to guess. So the countries that are buying it up, that's a show of strength. It's very psychological. It's a show of strength, and it's a show of viability of their currencies. That's my best read on that. Mm-hmm. I can't read their minds, but that tends to be a pretty. If you're inclined to doubt a foreign currency on the one hand, and then you find out, well, wait a minute, they've got it's backed by a lot of gold. That's a viable country if they really in fact have the gold stores that they talk about, and so it would tend to produce the faith that you want in the currency to get people to at least dip their toe in the water. Mm-hmm. But I don't know. That's speculation on my part.
Mm-hmm. So getting back to this idea of what's actually happening right now with let's say specifically the U.S. debt. If rates keep going up right now in the bond market, does this present a bigger problem for the Fed considering how much debt has to be rolled over this year?
Yeah. That's a major problem because you're running up against, the guy with the broken fingers at the OTB is like, well, you mean what are tax receipts? Tax receipts in the U.S. are on the order of $5 trillion. Your rates keep going up. Your interest payments are going to creep up. I think they're pushing $1 trillion right now. I mean, you're not there yet, but in the foreseeable future, yeah, your interest payments could get out of control when then you have to pay more in interest than you're collecting in tax receipts. Then you've got problems. You have to do something at that point because no one's going to take any new debt because they know you're not viable.
So I want to get back to this idea of, let's say, the mechanisms here as well. What problem does the Treasury dealers having large inventory present to the Treasury system?
The same problem a snake has when it eats a goat. I mean, it's got to process this huge thing moving through its body. That's essentially, there was a paper floated at a recent Jackson Hole conference, I think by Mark Duffy. Mm-hmm. Not Mark, it was somebody else Duffy. Mark Duffy, I know a dude named Mark Duffy. Anyway, and he said, yeah, they can only handle so much volume. And he had some metric for it to figure out how much volume they could have. And he's basically like, listen, sounding the alarm, like there's could reach a point in time where the primary dealers can't handle the debt volume. They just can't process. They're like the snake with the goat. They can't, the goat got too big. You can't, a 20-pound snake cannot eat a 300-pound goat. It's not going to happen. And not to survive the experience anyway. So there's different things to do. And so I think Duffy's paper was proposing, well, eventually you have to have the Fed buy the debt of the government. And under the debt-based monetary system, that's not an unreasonable conclusion, but it begs the questions, like back to the Bank of England example. It's like, well, if you can print the money, why would you delegate the job of printing the money to someone else and then borrow the paper? That's moronic. Mm-hmm. You in other words, back to the £1 million example with the Bank of England. When the Bank of England printed up the £1 million of notes and lent it to England, the interest payment on that's at 10% after a year is £100,000. That £100,000 is pure usury. It's pure usury. That's something for nothing. The Bank of England didn't do anything. They sprayed some ink on paper. That's it. That's worth $100,000. The England could have said, you know what? Go ahead and print the notes, and to pay the bankers for this wonderful service of putting ink on paper, they could have said, you know what? That's a wonderful print job. Why don't you peel a few notes off the top and put it in your pocket? Mm. But what you shouldn't do is pay interest on paper that someone else printed. That's I don't want to use the R word, but that's really, really dumb. Fair. Anyway, so it's the same with the Fed. So with the Duffy paper, it's like, well, if you're gonna have the Fed, buy the debt directly from the Treasury, mm-hmm. maybe we should have the Treasury just print the money itself and cut the middleman out without any interest payment. What do you think of that? Oh, no, we can't do that. Oh, no. The finance and economics profession is designed to service the Fed, and they're not going to hear of that.
And probably to obfuscate that fact as well.
Yeah, of course.
Mm-hmm.
Of course. I mean, the whole profession set up with, the arcane terminology. It sounds very scientific. It's all designed. It's a Rube Goldberg system to hide that scam at the root of it, which is issuing debt-based money. In other words, there is no Bank of England without England. There is no Fed without the U.S. government. Mm-hmm. The Fed was created in 1913. The U.S. government existed for hundreds of years before that. The founders knew better than to trust the central bank. The founders of the U.S. did not trust central banks. There was a central bank when the Constitution was signed in 1787, right? The central bank had been around. The Bank of North America had been around since 1781. Did you see the founders giving any power, any monetary power to the central bank back then? No, they gave it to Congress. They didn't trust central bankers, and we shouldn't trust central bankers. So why are you issuing debt-based money? I don't get it.
So if the Fed takes that money directly, does that end up being, highly inflationary if the dealers can't take it?
I thought so, but the more I think about it, it's like I don't think so. Because of that feedback loop, they're paying that money back into the system. The interest payment goes right back into the coffers of the U.S. government, and B, what created the inflation during the pandemic was buying the assets from the non-banks, which had the effect of bloating the commercial deposit base from $13.5 trillion to $18 trillion. That's where your inflation came from. Even though, again, nobody talks about that. Okay, talk about that. The only two people I've ever seen talk about it are me and Mervyn King, former head of the Bank of England. So I don't see that. If the Fed is buying, like you say, if that's the solution for the Fed to buy debt directly from the Treasury, I don't see that necessarily inflates commercial bank deposits. Because you got to remember, let me take a step back. In a debt-based monetary system, and throughout the West, and really throughout the world, it's a two-tiered system. You have a wholesale level and you have a retail level. Mm-hmm. The inflation comes from the retail level. The retail level is basically commercial deposits plus cash. But cash is a little confusing because it comes directly from the wholesale entity, comes from the Fed. But the inflation comes from the deposit base inflating up wildly like it did in 2020. That's where that came from. The wholesale level, look at what happened in the wake of the global financial crisis. The Fed printed money then too, but it bought assets from banks, and that's a wholesale player to wholesale player transaction. In other words, the Fed would print up, for example, $1 billion in deposits at the wholesale level, and go to some poor bank like Citigroup, and say, well, okay, what we're going to do is we're going to credit your deposit account, Citigroup, that you have on account with the New York Fed. We're going to add $1 billion to that account, which is a liability to us, but we're going to take your $1 billion asset. That's a purely wholesale transaction. There's no inflation of retail deposits, and thus there was no inflation in the wake of the global financial crisis when the Fed used the original QE to bail the banks out. Okay, so QE during the global financial crisis was fundamentally different than QE during the pandemic, where it wasn't banks involved. It was the Fed buying assets from non-banks. Mm-hmm. And because of that, the Fed did have to inflate. They had no choice but to pay people by adding money to their bank accounts. That's how that worked. So the notion that people have floated like, well, the Fed could buy treasuries directly from the U.S. Treasury, I don't see how that would necessarily result in a greater deposit base. And thus, I don't think, I did a video on it, and it's like, I might have gotten that one wrong. I might have to do a redo on that one, because I don't think it would be ultimately inflationary.
Yeah, it's such a It's always such a complicated puzzle to try to figure out, and it seems to never end.
It is. It's very difficult, and it's deliberately confusing. You know, frankly, part of the problem is when I study these things and look at them, there's a lot of unlearning that has to go on, because I'm bringing in assumptions and bringing in knowledge that I've had with me for 50 plus years that's not correct. Like the piggy bank model of money is wrong. That's not how the system works. When you wire, and the terminology too, like the other day I wired somebody some money, okay? There's not really a wire going from my deposit account to their account. That's what it sounds like, right? Mm-hmm. My account got drained $100 and they got $100 added. It's not how that works at all. At all. What happens is $100 gets deleted out of my checking account and $100 gets created at the other end. Mm-hmm. The only real transfer is a transfer of $100 in reserves, meaning bank deposits at the Fed from the banks, from one bank to the other bank. So the terminology and the two-tiered system is completely invisible to most people, but you have to know it to figure out what's going on. And like you say, it does your head in. It's confusing.
Mm-hmm. John, what are some ways out of this, looming debt scenario?
We need to get on Congress and start putting pressure back on Congress. Congress, when the people are interested in monetary issues, you tend to get a good result, or at least not a bad result. And I saw that during the global financial crisis, when people were really angry about bailouts, that Congress paid attention to that. They were getting phone calls at a rate of 200 to 1 against the bailout. And when the Fed then reached in and was bailing out the banks, Congress was on top of the Fed every day. Like, what are you doing with AIG? What are you doing with Citigroup? Why, they were hauling members of the Federal Reserve in pretty much on a daily basis. Mm-hmm. And during the pandemic, the Fed, the asset purchases were basically 3 times as large during the pandemic as they had been during the global financial crisis. And Congress didn't say peep because people were afraid. Mm-hmm. They were like, oh my God, the virus! Oh my God, I think I have a stuffy nose, my left nostril. I have a horrible disease. Totally ridiculous. They're scared. You know what? And no one was paying attention to what Congress was doing, and Congress let it go. And that's where your inflation came from. You have to, the first remedy is you cannot just sit there and think that all your problems are going to be solved with an app. You're not going to passively sit on your couch playing with an app and get out of this problem. You got to get involved. You got to race out with Congress. They'll find a way. Believe me, Congress will find a way. If you gotta let them know. But back when the Treasury and the Fed first floated the bailout proposal back in September of 2008, calls to congressmen, they were over 100 to 1 against, and that's when Congress pays attention and will do the right thing. Remember, the first time the TARP legislation came up for a vote, Congress voted it down on September 29, 2008. But then there was a high-pressure campaign and it eventually passed. But it goes to show you that when people get angry enough with Congress will do the right thing.
Mm-hmm. Well, and I think a big part of that is education, not only on Congress's side, but also the population side as well.
Yeah. I mean, but what I'm telling you though is there's no magical solution. There's no sort of trigonometric tweak that you can do with reverse repos or whatever to get out of this mess. Mm-hmm. You're not, like I say, you're not going to sit on your couch passively and get out of it. But now that said, you don't need a ton of people, but you need a segment of the population that's just basically knee walking, pissed off with Congress to get them to do the right thing. They'll find a way, but they're not going to. If you don't put the pressure on them, they're not going to do it. Mm-hmm. They're going to take their donations and they're going to sail into their golden retirement, and you'll never hear from them again. Mm-hmm. And we'll be stuck with the problems we have, but they'll only be worse. It'll be 10 times worse.
John, in the fall of 2019, we saw the Fed's reverse repo program see the repo rate spike overnight and threaten liquidity for the system. And right now, I keep seeing the size of this RRP program has been dwindling rapidly. So does this present a larger issue for banks again? And in a way, where do you think that this drawdown in the system, where did that come from, or who did that come from?
Well, the Fed is, they're deliberately reducing the size of their balance sheet. And the way they're doing it is with reverse repos. That's where you see the declines in the balance sheet. The reverse repos at one time, they were over $2 trillion, and now I had a graph of it up for a minute. I don't see it anymore. Now they're down. It's a lot smaller, and it's approaching zero. Mm-hmm. So reverse repos are on the liability side of the balance sheet, right? So if it gets to zero, where's the next reduction going to come from? If it's not reverse repos, let's say reverse repos decline all the way down to zero. How does the balance sheet continue to reduce at that point? And the answer is from the reserve accounts the commercial banks have on account of the Fed. We call them reserves, but they're called other deposits. If you look at the Fed's H401 report, other deposits by institutions, that's coming down. And the danger of that is that if those deposits keep coming down, right now it's not an issue because the reserve requirement is 0%. Remember in March of 2020, one of the measures taken in response to oh my God, the virus, one of the responses to that was to reduce the reserve requirement from 10% to 0%, where it has remained ever since. But you could see, it could go back to 10%. It could go higher to 10%. And if it goes, to 10%, and you've got, if you've got, I just told you there's $18 trillion on deposit by commercial banks at the Fed. If there's a 10% reserve requirement, it means the total accounts that banks have at the Fed has to be at least $1.8 trillion. And right now it's, what is it? It's 3.2 trillion. Okay. So you cut that by 1.4 and you're right there at 10% if there's a 10% reserve requirement. That's you get what I'm saying. That it leaves a lot of power in the Fed's hands. And remember, the Fed can raise and lower the reserve requirement without congressional approval. They did that. They proved that in 2020 when they cut it from 10% to 0.
Mm-hmm. Well, John, as I understood the reverse repo program, that basically facilitates overnight lending between banks to facilitate, as you kind of used with the wire example, this transfer of interbank balances, right?
Short-term liquidity between banks, yes. Mm-hmm.
But if that does go, let's say it does go to zero as the Fed tries to run down their balance sheet, does that program cease to have the function of facilitating that interbank liquidity?
Yeah, but it doesn't. It would if it's at zero by definition. It wouldn't facilitate it anymore. But it doesn't mean that banks don't have other ways to find liquidity.
Okay.
For example, they could borrow from federal home loan banks. They do that all the time. In fact, when the banks are the predominant borrower from the Federal Home Loan Board. Originally, it was set up, I think, as a farm program, but like everything else, it gets corrupted and becomes in the service of the big money center banks in New York, and there it is now. So the banks have other ways to get liquidity. They might have to pay more for the liquidity, but there's other ways they can get liquidity. And the Fed's not going to remember. The commercial banks own the Fed, right? So the biggest two owners of the New York Federal Reserve Bank are J.P. Morgan Chase and Citigroup. So the same group of people who own the Fed own the commercial banks. The Fed, I don't think the Fed's going to let the commercial banks fail. And it gets back, so why the liquidity problem in September of 2019 in the repo market? And the answer to that is, I don't know. And I don't think anybody knows. I've never seen a compelling explanation for what happened there. ever. I mean, if you know of one, I'd love to see it. I just haven't seen one. I've seen a lot of, there's this and that, and there's sunspots. That doesn't cut it.
John, this brings us to your new series called The War for Bankocracy. As you said, it's going to be an 8-part series, and you've just released the first episode to explain the complexity of central bank issues. So if anybody remembers back to right after the election, Powell stated that he would not leave his post if Trump asked him to, and Trump as well said that he wouldn't ask Powell to leave either. Why is that a big deal?
It's a big deal. The Trump involvement in it is not a big deal. That's not really the issue. Mm-hmm. The issue is that the Biden administration in May of last year, so May before the election, as Biden is starting to stumble and dotter more and more, the White House issues a paper that no one seemed to notice called The Importance of Central Bank Independence, where they said some things in that paper like, modern countries, modern economies are governed by central banks that are just patently untrue about the U.S. And that memo by the Biden White House did not mention the U.S. Constitution, didn't even mention the Federal Reserve Act, and it used a lot of language that I found alarming legally, that was very, to my way of thinking, anti-constitutional, because it treated the Federal Reserve like every other central bank in the world. It treated it like the European Central Bank. And the Federal Reserve is fundamentally different from the European Central Bank due to the U.S. Constitution. Because the Constitution gives Congress the monetary power, the Fed's authority, whatever authority the Fed has, it comes under the Federal Reserve Act. Congress could repeal the Federal Reserve Act tomorrow if that's what it wanted. So the Fed is different. It's under the heel of Congress. That's different than the ECB. The European Central Bank really is independent of those countries. The ECB can do whatever it wants, and you've seen it do whatever it wants. It shuts off ATM machines in countries that it doesn't like. It did that with Greece. The ECB can be really nasty to those countries, and it can do so with impunity because it's independent of those countries. In fact, it's legally, it's illegal for the European Central Bank to even accept input from national governments, and it's illegal for national governments in Europe to even try to influence the decision-making body of the ECB. That's the opposite of the U.S. system with the Constitution. And so I see that really what's keeping control of the Fed and of the world reserve currency, and what's giving us some measure of transparency into the Fed with the world reserve currency is the U.S. Constitution. So I knew this was going to become an issue, the issue of Federal Reserve independence and what that means. And so I started this series. I started working on it back in September, and I'm putting it out now just to sort of bring people up to speed. I don't know how this issue is going to manifest between the spiraling debt and everything else, but I can see the powers that be do not like the fact that the Fed is constitutionally inferior to Congress. They don't like that. The Fed and the central bankers, they hate central control. They do not like that. They are completely opposed to that. They think that they are the experts, and the best course of action is no transparency and just leave them alone and let them totally control your currency, which is absolute poison. That's not what you want. And so I started working on a series because I could see something coming down the road along the lines of a constitutional convention or some other way, some other method to amend the Constitution, which is don't do that. Mm-hmm. When to completely argue against that, that's a disaster waiting to happen. So I tried to get out in front of that with this series. And it's going to be an 8-part series. I've released one episode. Another one should be coming out Tuesday. But anyway, that's a series I'm working on. It's called The War for Bankocracy. And it really traces the history of central banks and central bank control and how they want to get more and more control. It really lays it out.
So that Biden memo, if it's just a memo, does that just, let's say, put the ideas out there that the Fed needs to have less transparency, basically? And does that basically set the groundwork and not necessarily make any legal changes to what the Fed has to respect?
That's a good question. Well, let's start with a threshold question. Like, well, why should I care about the Biden memo? Because we had an election and now Trump's president. The significance of the memo, because it involves the Federal Reserve, is it reflects the thinking of the powers that be. And frankly, I think if you look at Trump officials, their thinking, and really the thinking of the entire finance and economic profession, it just would never occur to anybody to question Fed officials. They all go along with the ultimate program. And so the fact that the Biden memo comes out in May of 2024 and says these things, it reflects the thinking of the powers that be in the monetary policy circles. That's the problem with it. And it ultimately does get to, when it says, countries in modern economies are governed by central banks, that statement is wrong as a matter of law. The U.S. is governed by the Constitution. Mm-hmm. It's not governed by a central bank. It's not governed by an independent central bank. Central bank is a minion in our system, and it should be. The Federal Reserve is a creature of Congress in 1913. Like I say, Congress could repeal the Federal Reserve Act tomorrow if it wanted. So Congress always has total transparency. Congress has as much transparency into the Fed as it wants, because Congress can shut down the Fed tomorrow if it wants and get all the documents from the Fed that way. Now, courts aren't going to make Congress go to that length. They'd simply order the Fed to turn over the documents. So there's a lot of hand waving going on. Well, the Fed's independent and blah, blah, blah. Congress, nonsense. Congress can get whatever information it wants from the Fed. And I think what I'm seeing with that memo is there's a movement underway to cut loose from that system, to cut loose from the constitutional system. And that's dangerous. You do not want that to happen.
Mm-hmm. John, what's the difference between central bank independence versus Federal Reserve independence?
Central bank independence means the central bank doesn't answer to the country. So the ECB doesn't accept input from any of the countries, and those countries are prohibited from trying to influence the central bank. That's central bank independence. Federal Reserve independence just means that the Federal Reserve is independent of the executive branch. Okay? It's what's called an independent agency. Mm-hmm. Independent agencies are agencies that are set up by Congress, and the head of the agency is not a cabinet position. Doesn't answer to the president. So the president, let's talk about the president's cabinet. So Treasury is a cabinet position. The head of the Department of State is a cabinet position. The head of the Justice Department, the Attorney General, that's a cabinet position. Those are the guys in the president's cabinet. He can fire them tomorrow if he wants. That's not true of independent agencies. Independent agencies are set up by Congress, and the president can't just go in and start firing people who head up independent agencies, not legally. And if the president does so and is challenged doing so, a firing order really would have no legal effect at the end of the day, because the Fed just doesn't. I mean, the president just doesn't have that authority. So Federal Reserve independence means that the president can't fire Jerome Powell. And you saw that. Powell said in a press conference the day after he was elected, he was asked, are you worried that President Trump could fire you? He was like, no. They're like, would you leave if he fired you? He was like, no. And they go to Trump the next day. They say, hey, Jerome Powell said he wouldn't leave. Are you going to try to fire Jerome Powell? And what does Trump say? He says, no, I don't see it. I'm not going to do it. Mm-hmm. Because he knows that you can't fire the head of an independent agency, and the Federal Reserve is an independent agency. It's a creature of Congress. Mm-hmm. But the Federal Reserve independence, the people who are talking about Federal Reserve independence, who are like pushing like, Federal Reserve, it's independent. What they're trying to do is salt in the notion that the Fed is independent of the entire government. Mm-hmm. And that's false. That's false as a matter of U.S. constitutional law. Yeah,
because as you go through, there's a relatively simple set of steps that Congress would need to go through, Congress and the president would need to go through to get rid of the Fed if that was the course that they chose, right?
Yeah. Majority of the House, majority of the Senate votes on a law repealing the Fed. The president signs it and the Fed's gone. It's that simple. Majority. That's all you need.
Well, John, I really look forward to episode 2 and the rest of the series as well. You put a lot of work into it. It's very highly produced, very, very striking. You know, it's a lot to dig into, but I appreciate that you've taken the time to try to explain it to us, because, you know, there's so many of these things that do ultimately matter. And I think it needs to be a big piece of the education of a lot of our society.
Yeah. Well, I'm glad you liked it. The next episode is going to get into the real source of Federal Reserve power, the real source of central banking power. It'll be a good episode, but I take extra effort and extra steps to really walk through the documents. Like, you know, I show the Constitution, I show the Federal Reserve Act, I show these treaties and say, this is what's going on. I mean, it's not like, you know, these central banks, there's a mystique about central banks as if they existed when someone, you know, pulled a sword out of a stone in the mist. It's not what they are. They're creatures of law. And you got to show the law to know what's going on. And that's what I try to do.
Absolutely. So that's all going to be available on your YouTube channel, the Best Evidence YouTube channel, as well as on your Substack and at solari.com, right?
Yeah, so the series will be available on my Best Evidence YouTube, on Odyssey, and on BitChute. I also have mirror YouTube channels. The fourth source is solari.com, where I wanted the series, because YouTube, Odyssey, BitChute, Substack, all these guys, they could shut me down tomorrow if they want. And I don't want to put this much work into it and have it go bye-bye. So I went to Catherine Austin Fitz of solari.com and said, hey, would you be sort of the guarantor of this series where people could go to and watch it on your channel? And in addition, you can download the documents and download the clips, the congressional clips that I show in the series for other creators and other researchers to use if that's what they want to do. And she agreed. So it's really sort of an open source project with Catherine's involvement. She's really backed me on this, and I appreciate it.
Excellent. Well, John, we look forward to the next couple episodes, and I hope, you know, my audience checks it out as well here.
Thanks, Tom.
Excellent. Thanks for your time today, John. Really appreciate it.
Yes, sir.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.